First of all, let me congratulate everyone who took initiation to watch the series which you are studying about derivative markets, that is future and options. This is the first video in this series. My primary focus will be trying to explain the things in the most simple language without leaving any major contents. We will be starting from the scratch and we will be progressing to the most complex topics. Don't worry, once again, I am here to make the concept simple for you. So before starting this video, please keep a notebook and pen with you and write down the important points in a book and maintain this notebook throughout this series. I will promise you one thing, when my future and options series is completed, you will become a master in derivative market. So let's go. As you know, India is the world's biggest derivative market in the world. 80 to 85% of trading volume is happening in future and option market. So after few years in cash market, people will normally move towards future and options. So we are here to explore the world of future and options. I'll be trying to keep the videos short as 10 minutes, but this 10 minutes is going to give you a lot of information, so please pay your full attention. As we all know that future and options is called as derivatives, or some people call it as derivative market. So don't worry if someone tell you I am trading in derivative market, it just means that they are trading in future or options. And future and options is a product which is derived from an underlying asset. Now you will be thinking that what is an underlying asset? Don't worry, to understand the concept of underlying asset, we will take an example. We all know about crude oil. Now if I ask you what are the products of crude oil, what you will say? You will say like petrol, diesel, LPG. Correct, right? Or you may say like tar and chemicals. They are the products of crude oil. Basically, all these products are derived or they are produced from the crude oil. So these products are called as derivatives. They are derived from crude oil. And here the crude oil is the parent product that is called as an underlying asset. I hope this is very clear for you. Now what will happen if the price of crude oil increase? Of course the price of petrol and diesel will also increase, correct? That means whatever change is happening in an underlying, that is reflected on its derivatives. Now let's go to our playground, that is stock market. Here what are the underlying assets? Shares of various companies like Reliance, Asian Paints, HDFC Bank, etc. or commodities like gold, silver or bonds, they are all example for the underlying asset. Now what are derivatives? Reliance future contract is a derivative, Reliance call option is a derivative, Reliance put option contract. These all are examples of derivative. Now what will happen if Reliance share fall 20%? Of course the Reliance future contract and option contract will be affected. Now you will be thinking that what I am telling about this contract. So let's discuss what is a contract. To understand the concept of contract, let us take an example. See, before this I want to tell you one thing. I made these topics after thinking and planning so much, so that even an 8th standard student can easily understand when he watch my videos. So when your basics are clear, you won't feel much difficulty to understand the advanced concepts. Now let's see the example. Consider here is a farmer who cultivates tomato. He started cultivating tomato on 1st January 2022. On 1st January 2022, 1 kg of tomato was having 10 rupees per kg. So when the farmer started cultivating, he knows that the tomato will be ready to go in the market by March 1st, 2022. But the farmer is very much afraid of one thing. Can anyone guess what is that? Yes, of course, he is afraid about the price of tomato on March 1st. It can be 100 rupees, it can be 10 rupees or it can be even 5 rupees. Whenever this farmer is going to sleep, he'll be thinking of the same thing. If tomato was having only 5 rupees per kg on March 1st, 2022, the farmer will be losing his entire money and effort. Because of this mental pressure, what farmer did is that he went to a wholesale market dealer, and this farmer asked this wholesaler, that is the market dealer, about the price of tomato in March 1st. By seeing the tension and sweating of farmer, the wholesaler easily figured out that the farmer is very much afraid about the price of tomato. So the wholesale market person took this as an opportunity. You know what he did? He gave an offer to the farmer that he will be ready to take his entire tomato when it is ready by March 1st for 20 rupees per kg. After hearing this from the wholesaler, the farmer was very happy because he is getting 20 rupees per kg on the time of harvesting. Now he can sleep peacefully. But actually the wholesale market person was very clever that he knows that the shortage of tomato will be there by March 1st and he can sell it at much higher price. But at current situation both of them are happy. Now the farmer and wholesaler dealer will make a legal contract stating tomato will be purchased at 20 rupees per kg and so on. This contract is called as forward contract. Now let us go to March 1st and see what is the market of tomato. Imagine there are three situations. In the first situation, tomato is having less than 20 rupees. The second situation, tomato price is exactly 20 rupees. And the third situation is tomato price is more than 20 rupees. In situation 1, where per kg is less than 20 rupees, farmer will be very happy because he got 20 rupees from the wholesaler, whereas wholesaler lost his money because his view about the tomato market went wrong. In second situation, where per kg is 20 rupees, farmer is still benefited, but wholesaler is in a no loss no profit situation. Whereas in third situation, tomato is greater than 20 rupees, farmer is still benefited, but he won't be feeling good from inside because tomato costs more than 20 rupees per kg. If he might have not made a contract, then he might have got at a better price. But here the wholesaler is benefited because his view about the tomato price went correct. So what we discussed in this example, it was telling about only forward contract. But when we discuss about stock market, such contracts are called as future contracts because future contracts has some advantages over forward contracts. Let's discuss what are the advantages of future contracts. There are no regulatory body between the farmer and the wholesaler. But in stock market, Security Exchange Board of India (SEBI) is standing as a regulator in between these two contracts. In last example, both the farmer and wholesaler dealer cannot exit after the contract is made. But whereas in future contract, in stock market, the buyer or seller can exit from the trade at any time. Even after few seconds also, it is possible to square off the position. In future contract, the quantity is traded in lots. For example, Reliance Future is trading at 250 quantity of shares. Nifty is trading as 50 quantity, like that. Here in future contract, the trades are executed in between NSE or BSE. Now let's discuss some basic questions about future contracts. The first question is what you can do in future. One of the most useful thing in future is that you can short sell any stock and keep it overnight. But this is not allowed in equity. You can do it in intraday, but you cannot carry your position. Here in future, you can carry your short position until expiry. You can also buy or sell index, that is Nifty or Bank Nifty. Most volume is always seen in Nifty and Bank Nifty indexes compared to that of stocks. Also, you can buy or sell futures of commodities, for example gold, silver, etc. The next question is that how many expiry is there in a future contract? The answer is 3. There are near month expiry, next month expiry and far month expiry. I will show you this in broker terminal. You can see this 3 months. This is the near month expiry, this is the next month expiry and this is the far month expiry. That's it. Now how to check the lot size in TCS? Just come to your watch list and type TCS. Click on the buy or sell button. Here you can see 150. The next question is that when is the expiry happening? Expiry is happening on every month last Thursday. The next question is that why should I trade in futures? The answer is to get the margin benefits. For example, to buy one lot of Reliance future, that means 250 shares, you need only 1.3 lakhs rupees. Whereas to buy 250 shares of Reliance in equity market, you need around 5 to 8 lakh rupees. So with less money, you can buy or sell more quantity of shares. Another advantage is that the total tax, security transaction tax (STT), is less in future trade compared to that of cash market trade, that is equity trades. Hedging and arbitrage we will discuss in coming videos. That is also an advantage of future trading. How to check the margin required? We already discussed that future is a margin product. So we don't need to spend complete money but a certain percentage. This percentage is decided by the exchange. You can check the margin by using a margin calculator. You can type margin calculator in Google and select this link. Select the segment, script and expiry and click add. It will show the total margin required. Upfront margin and exposure margin we will discuss in the coming videos. Or if you go to this broker terminal also and click on the script, it will show you the margin required. In future trading, you should remember one thing, that one person's loss is another person's profit. Money will be credited or debited from your account on the same day. It is called as settlement. In coming videos, we will discuss how settlement will occur in detail. Exit can be made at any time, we already discussed that. Once you exit from the position, whatever margin is blocked when you enter in a trade, that will be released immediately to your trading account. In coming videos, we will discuss about future price, spot price, how difference is occurring, rollover contract, how future price is calculated, how settlement is working, what is hedging, what is arbitrage trading, etc. One thing I can guarantee you, that you will not get such easiest explanation about future and options in YouTube. Please like and subscribe, and also tell your feedbacks or doubts in the comment section. If you are interested to follow me on Instagram, you can also follow me on Instagram. Here I post normally 1-minute videos, mostly educational videos. So that's all for today. Stay healthy, take care, see you on next video. Bye bye.